Taxes, taxes, taxes. Where should you relocate your tax obligations? Which country offers the most advantageous conditions and how does it all work? Watch this video until the end to discover the top European countries with a special tax regime. Hello everyone, welcome to the Guided Immigration Agency channel. Subscribe to stay informed on all things migration, relocation, freedom of movement and expert life hacks. In this video, we will explore alternative tax solutions for high net worth individuals. Why are people looking for new tax havens? The recent abolition of the UK's non-dom tax regime will force nearly 70,000 relocated individuals to pay higher taxes in the UK. As a result, financially dependent people are now searching for alternatives, looking towards European countries with more favourable tax policies. Some choose the UAE's free economic zones, tax-friendly jurisdictions like Malta and Cyprus, Caribbean nations or Vanuatu. These locations are attractive not only to the wealthy but also to residents seeking tax optimization. However, many high net worth individuals have business and personal ties in Europe and prefer to stay within the EU or neighbors countries. So, which European countries offer attractive alternative tax regimes? Let's take a look. France. Zero tax for non-residents. If you live in France under a financially dependent visa without becoming a tax resident, you pay no taxes at all. However, if you seek tax optimization, permanent residency or citizenship, you must become a tax resident. If you don't own property in France, you will need to declare and pay income tax on all worldwide earnings. Social security contributions are also required. Greece. Fixed tax for wealthy individuals. Greece offers a fixed annual tax of 100,000 euros regardless of global income levels. Family members included in the application can benefit from tax reductions, paying only 20,000 euros per year. Given that Greece's progressive income tax rate reaches 44%, a fixed tax can be a more cost-effective option for high earners. Ireland. Tax on remitted foreign income. Ireland's tax system allows individuals to pay tax only on foreign income that is remitted, transferred into Ireland. No minimum annual tax requirements. No time limits on the preferential tax regime. No minimum stay requirements to maintain tax residency. Family members cannot benefit from tax exemptions. To retain tax privileges, individuals must demonstrate that Ireland is not their primary place of residence. Italy. Flat tax regime for high earners. Introduced 7 years ago, Italy's flat tax regime was designed for wealthy residents. Previously, Italy's standard income tax rates were high, discouraging wealthy individuals from relocating. Now, tax residents can pay a fixed annual tax of 100,000 euros on all global income earned outside Italy. Family members can also opt in, paying only 25,000 euros per year per applicant. Enjoy exemptions on inheritance tax, gift tax, wealth tax, and financial asset taxation. This tax regime is valid for 15 years and does not require a minimum stay. Malta. Special tax rules for non-doms. Malta offers special tax conditions for individuals registered as tax residents but not permanent residents, res non-doms. Only income earned in Malta and foreign income remitted to Malta is taxed. Only income earned in Malta and foreign income remitted to Malta is taxed. A fixed annual tax of 5,000 euros applies to non-domicile tax residents. No strict residency requirements making the tax regime indefinite. To maintain tax benefits, residents must demonstrate that Malta is not their primary home. Switzerland. Lump sum taxation for wealthy residents. Financially dependent individuals living in Switzerland and not formally employed can opt for a simplified tax system. Instead of taxing income, Switzerland calculates annual tax obligations based on living expenses rather than earnings. The final tax amount is approximately 7 times the annual rent or estimated rental value if owning property. Each canton set its own tax rates, so amounts vary. But some cantons have abolished this scheme. This favourable tax option can be used indefinitely. Monaco. No income tax for residents. Monaco remains one of the most tax-friendly jurisdictions. No personal income tax, except for French citizens. No real estate tax or capital gains tax. No tax on foreign dividends. No inheritance tax, except when assets were transferred outside direct family members. However, becoming a tax resident in Monaco requires purchasing or long-term renting a property, which is very expensive. Strict residency rules, including staying in the country for at least 183 days per year. Andorra. Low fixed rate taxation. Andorra offers a flat tax system with rates up to 10%, depending on income level. No zero tax on income up to 24,000 euros. 5% tax on income between 24,000 euros and 40,000 euros. And 10% tax of income exceeding 40,000 euros. Corporate tax in Andorra is also low, ranging from 0 to 10%, while VAT is 4.5%, one of the lowest in Europe. Additional tax benefits in Andorra: no inheritance tax, no wealth tax, no capital gains tax on gifts, no currency exchange control. To qualify for tax residency, individuals must obtain at least residence permit, prove financial stability, buy or rent property for long-term residence. Other European countries also offer tax incentives, but we cover the most popular jurisdictions for tax optimization. Which tax regime best suits your needs? It all depends on your goals. Whether you are relocating as a financially dependent person, registering a business, or seeking another solution. Leave your questions in the comments and don't forget to subscribe to our channel. This is all for today. It was Mariana, migration specialist from licensed agency Garant In. That's all for today. See you, bye bye.